Welcome once again. This is Pinnacle Professional College, and today we bring to you another lecture on strategic case study. If you haven't watched the previous videos, please do so because it's critical, because it serves as a foundation for understanding what we'll be teaching today. If you haven't subscribed to this channel, please do so and share this video with your friends and any other person who might be interested in it. So today we'll be discussing value chain. Value chain. Very, very important. So what's value chain? First, we'll be defining what value is. We'll talk about the concepts of the value chain. We'll talk about primary value chain. We'll talk about secondary value chain activities. We'll talk about how to add value. We'll talk about the value chain analysis as well. So when we say value, what do we mean by value? When we say value, what do we mean? I'm sure, some thoughts might have come into your mind, but value is simply the benefit a customer derives from a product. It's basically the benefit a customer derives from a product. So when we say, value, that's exactly what we mean. And these benefits are derived from the attributes or the features of the product, right? So for example, this lecture is a service or a product that you are receiving, and you are deriving values and benefits from it. So customers would pay you based on the value that they receive. It's very, very important. So business entities create added value when they make goods and services. They create added value when they make goods and services. For example, if a business entity buys a quantity of leather for 10,000 Ghana cedis and converts this into leather belts, which it sells for 100,000, it has created a value of 90,000. Right. So if a company gets a raw material, right, they get a raw material and then they add value to it, right, and create another whole new thing. The difference in that is what we call the value. So if you get a raw material for $10,000, you sell it for $20,000, the value add is 10,000. If you get something for 10,000, you sell it for 30,000. If you get something for 10,000, a raw material for 10,000, and then you convert it into some kind of finished product, which has a value of 30,000, then the value added is 20,000, or the value that has been created is 20,000. In a competitive market, the most successful business entities are those that are most successful. In a competitive market, the most successful business entities are those that are most successful in creating value, right? So organizations that create value would be competitive in the market. Very important. And this is, kind of intuitive as well. If an organization is able to create value, then they will be successful. Porter has suggested that if a firm pursues a cost leadership strategy, its aim is to create the same value as its competitors, but at a lower cost. I'm sure by now you should know a cost leadership strategy. Cost leadership strategy is a strategy that focuses on becoming the least cost producer in the market, right? So basically, cost leadership is producing at a low cost, or selling at a low price, right? So firms that compete on price by, basically selling for cheap, because people are attracted to low prices. That's cost leadership strategy. So the aim is to create the same value as competitors, but at a lower cost. So for example, if we have two phones and those two phones, you know, offer the same value, but one producer sells the phone at 10% lower than the other, then that producer is leading on costs. It's leading on costs. If a firm pursues a differentiation strategy, it aims to create more value than its competitors. Right? So you see the difference. So a differentiation strategy is basically, right, a strategy that a company pursues to make its products unique. And how do you make a product unique? You make a product unique by its features, its attributes that are distinct from competitors. So when you pick Apple, Apple is unique. Apple iPhone, right? Apple MacBook, Apple iPhone. These are unique devices that are different from competitors. And the aim here is to create more value than its competitors. The only reason why a customer should be willing to pay a higher price than the lowest price in the market is that he sees additional value, right? If a customer sees value, then they'll be willing to pay a higher price. One of the things you need to know here is that value can be real or perceived. Value can be real or perceived, right? And what does this mean? Not all value is real. Some kind of value could be perceived. So for example, a customer might be willing to pay more for a product with a well-known brand name, right? And things like brand name does not necessarily imply good quality. You know, things can have a good brand name, but it does not mean it's of good quality, right? Or it does not mean you can not get an alternate product of the same quality, right? So let's think about an example. If you pick, for instance, let's use phone devices once again. Right? Let's use phone devices. There are different kinds of phones out there, right? But if you pick, let's say, a techno phone, right? A techno phone can literally do most of what a Samsung phone can do. Can literally do everything. But in terms of brand name, Samsung is more powerful in brand name, right? And this value is in the imagination of the customer. And it's imagined, it's perceived, right? It's perceived. So it says here that, for example, a customer might be willing to pay more for a product with a well-known brand name, assuming that a similar non-branded product is lower in quality. This difference in quality might be imagined, see, rather than real. Even so, the customer will pay the extra amount to get the branded product. The extra value might relate to the quality of design features of the product. So that's another point, right? So the value might be real or perceived. The extra value might relate to the features or the attributes of the product, right? So you need to know that when you look at the marketing mix, there are other decision points that would influence a customer to make a purchase, right? So if you look at the marketing mix, a customer, for example, will compromise on price just because of how quickly they can get the product, which is convenience, right? So the extra value might relate to the quality or the features of the product. Very, very important. Now let's move on to other issues. Let's talk about the concept of the value chain. I'm sure you might have heard the value chain. We've discussed what value is. Now let's move to the value chain. The value chain is basically a framework or a structure for analyzing how value can be added to a product or service. So Michael Porter, once again, grouped activities into a value chain, grouped activities of a company into a value chain. So when we say a value chain, it's simply a series of activities that add value, right? So every product will go through different stages along the chain, and along these different stages, value is added. Along these different stages, value is added. Very, very important. So the total value added by the entity is the sum of the value created by each stage along the chain. Now let's look at how Johnson and Scholes defines the value chain. Johnson and Scholes have defined the value chain as the activities within and around an organization which together create a product or a service. It's basically the activities that an organization engages in to produce a product or a service. Strategic success depends on the way that an entity as a whole performs, but competitive advantage comes from each of the individual and specific activities that make up the value chain, right? So if you want to achieve competitive advantage, you need to look at the activities that make up this value chain. So within an entity, there are two types of activities. There are primary activities and there are secondary activities. We'll look at each of them, right? So let's look at the primary value chain. Let's look at the primary value chain. Porter identified the chain of activities in the primary value chain as follows. You have inbound logistics, you have operations, you have outbound logistics, you have marketing and sales, and then you have service. Now, I'll show you an easy way to remember this so that you do not have to memorize. Think about it. When a product, you are trying to create a product, what do? You first get raw materials, right? That have to come in. So inbound logistics is coming in. These are inputs. Then now you have to come and process this raw material. That's operations. You have to process or convert. That's operation. And then outbound logistics, right? After you've processed it, you get an output. That's outbound logistics. And then you have to come and market and sell it. And then you have to think of after sales services. So let's go into them one by one. What you need to know before I dive into it is that most value is usually created in the primary value chain. Always remember that the most value is usually created in the primary value chain. Let's pick inbound logistics. Let's pick inbound logistics. Inbound logistics, these are the activities concerned with receiving and handling purchased materials and components. These are the activities concerned with receiving and handling purchased materials and components and storing them until needed. See? So receiving and handling purchased materials and components. Inputs, inbound, that's what it means. In a manufacturing company, inbound logistics therefore include activities such as materials handling, getting the materials from suppliers, inventory management, inventory control. What you need to make your product, you have to get it from a supplier. It has to come into the organization as an input from the supplier, right? So that's inbound. Then you have operations. These are activities concerned with converting the purchased materials into an item that customers will buy. So here you are looking at conversion. In a manufacturing company, operations might include machining, assembly, packing, equipment maintenance, testing, etc. So operations is looking at processing and conversion. Then you have outbound logistics. Outbound logistics, these are activities concerned with the storage of finished goods before sale and the distribution of and delivery of goods to the customers. For services, outbound logistics relate to the delivery of a service at the customer's own premises. So outbound logistics, you are looking at finished products. Inbound logistics, you are looking at raw materials and components. Operations, you are looking at processing and conversion. Outbound logistics, you are looking at finished products. And then you have marketing and sales. Marketing and sales. So what's that about? So marketing and sales. Let's look at it critically. These are the activities that inform customers about the product. These are activities that inform customers about the product, right? And persuade them to buy. So you market the product. After you created the product, you don't market it, nobody will know about it. So you have to advertise the product, you have to promote the product. That's marketing and sales. And then you have service or after sales service. These are all the activities that occur after the point of sale, right? So after the point of sale, you have things like installation, you have repairs and maintenance, you have warranties, all activities that occur after the point of sale comes under service. So there are times where people go to buy television at a shop, and as part of the service, they install the television for you at your house, or they install the air conditioner or the air conditioning equipment at your house. Or typical example would be like a DSTV decoder or a multi-TV decoder. After you buy it, they come to your house and come and install it for you. That's service or after sales service. So you see, I hope you have an understanding of the concept, right? Very, very important 5 primary value chain activities. Very key. Very key. So you have inbound, you have operations, you have outbound, you have marketing and sales, you have service. If you have any questions concerning this, please don't hesitate to leave a comment and I'll definitely respond to it. Now, let's move on to secondary value chain activities, or what we call support activities. In addition to the primary activities, there are also support activities that drive the primary activities. And Michael Porter, so Porter is someone's name, right? Porter is someone's name. So Michael Porter, what he did was to identify these support activities. So number 1 support activity is what we call procurement. And when you hear to procure means to buy, right? So these are the activities concerned with buying the resources for the entity. So the resources that you need, you purchase them, right? So it could be materials, it could be equipment, etc. And then you have technology development. These are activities related to any development in the technological systems of an entity. So technology is very, very key for organizations today. So technology is also a support activity, right? So very, very important. Then you have human resources. Obviously, you cannot create a product without people. So these are the activities concerned with recruiting people, training people, developing people, and rewarding people in the organization. And then you also have corporate infrastructure, right? Every organization should have a structure. There should be an organizational structure, and there should be certain management systems that have been put in place. And this is also a support activity. So this would include things like quality management, information systems management, financial management, planning, etc. Support activities, what you need to know is that they are often seen as necessary overheads to support, like I said, or to drive the primary activities. Right? So, but you need to know that value can be created from support activities. So, for example, if we pick procurement, right? How can you add value in procurement? You can add value by identifying a cheaper source of materials, right? A cheaper, relatively high quality source of materials. That's value. If you go to technology, technology can add value to operations, right? To operations and to even how you process your products. Technology can add value. Then you have human resources. Human resources can add value when you improve the skills of employees through training. And then you have corporate infrastructure. In corporate infrastructure, you can create value by providing, for instance, like an information system that helps management make better decisions. So you see, you can add value through the support activities as well. Now let's talk more about adding value. Adding value. Adding value. Let's talk more about adding value. Strategic management should look for ways of adding value because it improves competitiveness. We already talked about this, right? You should always look for ways you can add value at each stage in the value chain. And also you need to know that you can also add value through the support activities. So always finding ways to add value is very, very crucial. Always finding ways to add value is very, very crucial. Right? But to add value, there are a couple of questions that you need to answer. You need to find out who your customer is, what kind of products you are designing, what kind of value you want to create, what kind of value the customer wants, etc. Right? How can we add value better than our competitors? These are all questions that you need to ask yourself. Now let's move on to methods of adding value. What are the methods of adding value? There are different ways of adding value. Right? There's an important link between value and critical success factors for products and services. Right? So there's an important link between value and critical success factors for products and services. Now, one way of adding value is to alter a product design and include features that might meet the needs of a particular type of customer. So that's one way of adding value. You can add value through product design, right? That's one key way of adding value. You can also add value through convenience. Value can be added by making it easier for the customer to buy a product. So if the purchase is convenient, you make it more convenient. So for example, if I enter the banking hall and it's very, very quick to withdraw money, right? Or to process some kind of transaction, or I don't even have to enter the banking hall, I can do it online. That's convenience. That's adding value. You can also add value by promoting a brand name, right? When you promote a brand name, it gives customers a sense of buying a product that is of a better quality. You can also add value by delivering a service quickly, right? So for example, if I buy, that's one of the things that Amazon is good at. If I buy a product, what is the turnaround time in terms of when I will get it? That's also value addition. Another way you can add value is also by providing a reliable service, right? So reliability is also value. So that when I call and I need a service, I know I'm rest assured that at the promised time, it will be delivered. So in terms of expansion, when a company wants to expand its operation into new markets or into new segments, it should choose markets where the opportunities for adding value are strong. Very, very important. Always remember that. Always remember that. Now let's move on to value creation and strategic management. Value creation and strategic management. Value creation and strategic management. What is this all about? Value creation and strategic management. Value creation and strategic management. So how do these two relate? Right? If a firm successfully adds value, what will happen is that it will improve its profitability and sales. Right? So if they even do this a lot better, what will happen is that the customer will experience a better quality product at probably a lower selling price. Right? So, and this overall creates competitive advantage. Right? So you see how the cycle works. If you create value, the firm does well in terms of its profits and its sales, and then because you're seeking to create value, the customer benefits from a good quality product. And this is what Apple company has done, right? With their iPhones. They are constantly adding value. And so the quality is getting better. There's a link between corporate strategy, financial strategy, and investment strategy. There's a link between these three things. We are looking at value creation and strategic management. Value creation and strategic management. There's a link between these three things. There's a link between these three things. So what is corporate strategy? What is corporate strategy? We already discussed these things in my previous lectures. So if you haven't watched it, please do. Right. So corporate strategy creates value for the customer. We are looking at this in relation to value creation. Financial strategy creates value for shareholders. Investment strategy creates value for the future. Right? And these three things are linked. But at the center of it is value creation. Right? So for instance, let me give you an example. If you pick investment strategy, it creates value for the future. So it provides resources. And these resources would help create value for the customer. And then when you create value for the customer will reward you and you get more revenue and more earnings, right? When you get more earnings and revenue, it also creates value for shareholders by giving them dividends, right? If you create value for shareholders you can raise more finance with them because they'll be willing to invest in the company. When you raise more finance with them, then you can then again invest it which creates value for the future. So it's a link, it's a loop that keeps on going on and on and on, right? So it's very, very important to understand. Now let's look at how we can use the value chain analysis. How we can use the value chain analysis. The value chain model is another useful model for business strategy analysis. Right, so let's see how we can use the value chain analysis. it can be used for business strategy analysis, right? Very, very important. In your examination, the value chain model can be used to make a strategic assessment of performance, right? So what that means is that you can look at each of the activities in the value chain, and then you can analyze it, how well it's performing. So if you pick inbound logistics, how well are we receiving and handling materials from suppliers? If you pick marketing and sales, how well are we doing our advertising? Is it really resonating with our potential customer? For each part of the value chain, providing answers to the following questions can help assess performance, right? So these questions are critical, and I'll go through some of them. There are many more questions you could ask yourself. So how is value added by this part of the value chain? Has the entity been successful in adding value in this part of the value chain? Has the entity been more successful than competitors in adding value in this particular activity, etc.? These are all questions, and you can do that for each and every activity within the value chain. Very, very important within the value chain. So we've talked extensively about the value chain, and I hope you've been able to grasp exactly what we mean by the value chain. First of all, we explained what value is, right? We explained what value is. And we said that value is basically the benefits a customer derives from a product or a service. We talked about the value chain, which we saw to be a series of activities that add value. We looked at the primary value chain activities, the secondary value chain activities. We literally went through, all of that. We went through all of that. So I believe if you have any questions around that, please do let me know in the comment section, and I'll definitely answer it. Now, let's look at, I'll touch on this briefly, and then we can move on to other things. So let's talk about customer relationship management. We will define what it is, and we'll look at some strategies and software. So one of the key things you need to know is that it can be very difficult to retain customers. It's not easy. And to build up customer loyalty over time, it's quite difficult. So one of the key things organizations look at is customer acquisition and retention. They try to acquire customers and retain them over a long period of time. Now, you can acquire customers, but if they are not being retained, then that's a problem, right? And that's a problem. So initially, the purpose of customer relationship management was to help companies to understand the behavior of the customers better. All right, so that was the initial purpose of customer relationship management. All right, so customer relationship management was to help companies understand customer behavior a lot better. So and that was the whole idea of CRM. We're trying to assess the behavior of customers and try to tailor or modify our marketing operations in order to best serve these customers. So here we are trying to find out what are the purchasing habits and preferences of customers. What are the characteristics of our customers, right? And can we profile them, right? And we use all this information to be able to better serve our customers. However, customer relationship management has grown over time as technology has come in. It has improved, it has developed, and there are three areas of customer relationship management. There is analytics, there's operations, and there's collaboration. There's analytics, there is operation, and there's collaboration. So analytics section, as the name suggests, is about analyzing the customer data for a particular purpose. So typical example would be to analyze purchasing patterns, right? So a typical purchasing pattern would be, when does our customer buy credit? Do they buy credit on Saturdays when they are at home so that they can call their friends, right? That's a typical example of a buying pattern. And then you have operations. Operations involves supporting the sales and marketing and customer service processes. For example, contacts with the customer may be logged into a database, right? So operations is basically supporting the sales and marketing and customer service processes, right? That's fairly explanatory. So a typical example of operations, as I've already mentioned, is where you get the customer's details to log into a database. That's why sometimes when you call a call center, they ask you for your name. They can pull out your details, right? You go to a bank, you give them your account number, they can pull your details. So that's operations. Then you have collaboration. Collaboration refers to direct interaction with customers. And this could be through email, this could be through automated phone inquiries, text messages, etc. So these are the three arms of CRM now: analytics, operations, and collaborations. Now, customer relationship management is often associated with computer software. This is because companies that take CRM seriously will use CRM software, right? But what you need to know is that customer relationship management is beyond software. Customer relationship management is not just about the application of technology, but it's a strategy to learn more about customers' needs, behaviors, and to develop a relationship with them. To develop a relationship with somebody, you need to know them. So to develop a relationship with customers, you need to know them, understand their behaviors. Very, very important. So this is where we would bring today's lecture to an end. We've talked about CRM. We've talked about it briefly. We'll be diving into it a lot more in our subsequent sessions. If you haven't subscribed to this channel, please do so. And thank you very much for your time. Have a good day. Bye-bye.